Hello, everyone, and welcome back. I'm Richard Gray, creator of the Automatic Wealth System by Logical Flow. Today's lesson is lesson number 9. Lesson 9, the Freedom Fund. Why time turns volatility into your friend. Welcome back. In our previous lesson, we explored the safety fund, which is money designed to protect you from life's unexpected surprises. Its purpose was stability, accessibility, and peace of mind. Today we're kind of moving into the opposite end of that spectrum. We're going to explore the Freedom Fund. And this is the basket designed to build long-term wealth and give your future self more freedom, more choices, and opportunities. So throughout this lesson, we're going to be using the ticker symbol VFV as our example investment. VFV is a Canadian listed ETF that tracks the S&P 500. And what this is it represents approximately 500 of America's largest publicly traded companies. There are other ETFs that also track the S&P 500, but we'll use VFV throughout this course to keep our examples simple and consistent. In today's lessons, we're going to cover topic 1, why the Freedom Fund is different, why this money has a completely different job than your safety fund, and why your investment timeline changes how you should think about risk. Topic 2, understanding volatility, why the stock market doesn't move in a straight line, why temporary ups and downs are a normal part of long-term investing. In topic 3, we're going to talk about the psychology of market drops, why market crashes and corrections happen, how experienced long-term investors often think differently during difficult markets, why patience can become one of your greatest investing advantages. And finally, for topic 4, diversification and why we're actually using the S&P 500, why owning hundreds of leading companies can reduce the risk of relying on one advancement, why the S&P 500 is used as a measuring stick for long-term investing by various people, why probability may matter more than trying to predict the next winning fund or company, and why understanding what you own can help you stay invested during difficult times. So let's dive in. Topic 1, why the Freedom Fund is different. So, the Freedom Fund has completely different job than your safety fund. The safety fund protects you from today's emergencies. The Freedom Fund is designed to build tomorrow's opportunities. This money isn't next year, it's not for your car or your vacation. It's for the version of you that exists 10, 20, 30 years, even longer down the road from now. Because of that long time frame, we can invest differently. The safety fund values stability above anything else. The Freedom Fund values long-term compounding growth. And with greater potential growth comes something called volatility. And what volatility is it simply means the value of your investments move up and move down. So the higher the volatility, the more up movement and the more down movement. And that's perfectly normal. The key difference is this. The safety fund protects your present. We want low or no volatility. We don't need money going down when we need it the most. The Freedom Fund builds for your future. So we want volatility built in because over a long time frame, it smooths out. And especially if we're 10 years or further out, volatility is your friend for compounding gains. So, key takeaway, time changes what risk means. The longer your investment horizon, the more time you have to recover from a temporary market decline. Topic 2, understanding volatility. Many people imagine investing looks like a straight line that slowly climbs higher, but that's not how the stock market works. Some years the market goes up, some years it goes down. Sometimes it'll drop a little or go up a little. Sometimes it goes up a lot or drops a lot. These up and downs are the volatility. On the screen, you'll see two different charts. One represents a stable investment, like a high interest saving ETF, where growth is slow and relatively steady. And the other represents the S&P 500. So if we take a look at this, in image one, this is how people in their head think of growth. They think it's just going to be this nice steady line with no volatility. And if you chart it from the start to the end, that's just kind of showing you the average from start to finish. So if you look at this chart, you're going to tell yourself, man, I'm just going to put all my money in the S&P 500 because it just kills compared to our cash.to, which is in our safety fund. Unfortunately, that's not how it works, and that's why every investment that we do is a certain tool. So if we look at image 2, this is an actual thing, this is for educational, but this is how it could work. So imagine that you put everything in just the VFV, the S&P 500, and then an emergency happens in year 4. So you pull out in year 4 and you're at a 30% correction from your original investment, meaning you've been investing 4 years and you're taking a 30% loss on your money. It's self-defeating. You'll probably quit the system. It's not a good place to be. This is why we have the safety fund, and this is why we want the 3 to 6 months in it. And this is also why I said in the safety fund, we probably want to pad it a little at the start. So if we need money, we're not going through these psychological headaches of losing, right? And this is also where psychology plays and people try and beat the market. This is the worst news possible when you're down. It's like, this time it's different. The end is near. We're going to keep dropping. It could drop another 20, 30%. People think they're smart. They sell, normally at the bottom, and then they end up buying higher. Just take a look at the chart, read it, pause it if you want. I just want you to understand that this is why the Freedom Fund needs to be under a long time horizon. It's a very different tool than what our safety fund is. And the important lesson isn't that the market never fails, it's understanding that the market declines have always been a part of the journey. You don't earn long-term returns by avoiding volatility, you earn them by staying invested through it. The key takeaway is that volatility isn't a flaw in long-term investing. It's one of the prices we have to pay for the opportunity to earn higher long-term returns. Topic 3, the psychology of market drops. Let's talk about one of the biggest reasons people struggle with investing, not because they picked the wrong investment, but because they let fear make their decisions. Imagine you filled your car with gas today. Tomorrow gas drops 40 cents per liter. Most people don't panic. They don't have this weird reaction where they want to drain the gas out of their tank and try and sell it. Instead, they usually think, I wish I waited one more day, or I wished I filled up tomorrow. I wish I had more money or more room in the gas tank to fill up today and save. And why does this happen? It's because they're the buyer. Lower prices benefit buyers. The Freedom Fund works in a similar way. If you're investing every month and you don't need this money for another 10, 20, 30 years or more, temporary market declines can allow you to buy more shares for the same amount of money. That doesn't mean that market crashes feel good. They don't. Watching your investments fall can be uncomfortable. Throughout history, we've seen periods like the dot-com bubble, the financial crisis of 2008, the COVID market crash. Each one had different causes. Each one felt scary while it was happening. Many people believed the markets would never recover. Yet historically, diversified markets have recovered from major downturns and eventually reached new all-time highs every time. That doesn't guarantee the future. History can change, but there's an old saying: history doesn't repeat itself, but it often rhymes. And that's why we invest with probabilities, not predictions. The turtle doesn't panic during every storm. The turtle sticks to the plan. Key takeaway: long-term investors don't expect markets to be calm. They expect markets to recover over time, even though no one can predict exactly when. Topic 4, diversification and why we'll use the S&P 500. So for the Freedom Fund, I use VFV as an example of investing in the S&P 500, which many people use as the measuring stick of investments. This is not because the S&P 500 is the best performing investment every year. It will go up, it will go down, sometimes substantially. Other funds, markets, and strategy may also outperform it during certain periods. The question is about probability. Over the 10 years ending in 2025, approximately 97% of Canadian and US equity funds failed to beat the S&P 500. Some funds will perform, but identifying those winners beforehand and knowing when they will stop winning is extremely difficult. Your Freedom Fund is not money for next month. It's money for yourself and potentially your children and your grandchildren. When something is that important, I do not believe we need to gamble on finding the rare manager, the fund or investment strategy that might beat the measuring stick of the S&P. VFV gives Canadians a simple way to participate in the long-term growth of 500 leading US companies. It doesn't guarantee profits. The past performance cannot guarantee future results. But rather than constantly trying to outsmart the market, it allows us to improve our odds by owning the measuring stick itself. There are other excellent investment options, including Canadian, international, total market, global diversification funds, etc. And I will explore some of those in separate side videos, but the main atomic wealth lesson will remain simple and repeatable. So, most importantly, do not buy VFV or anything else just because someone on the internet mentioned it to you. I want you to understand what you're gonna own. Research it and make sure that the risk makes sense to you. Because when the markets fall, borrowed confidence disappears quickly. You may blame the person who suggested it, sell it at a loss, move into something that feels safer, and then miss the recovery upside that volatility gives us. The goal of these lessons is not to tell you what to buy. It's to help you think for yourself and make sense of the market. Research and make a decision you understand well enough to hold through the difficult times. This is your future, and you need to own the decisions you're making. The key takeaway: the S&P 500 will not be the best performing investment ever, and VFV does not guarantee profits. But instead of trying to predict the rare funds or manager that may outperform, VFV offers a simple way to own hundreds of companies that let diversification, probability, and time work on your favor. Most importantly, understand that what you're buying and making the decision for your own. Your freedom fund is for your future self and potentially for your children and grandchildren. So you need enough knowledge and confidence to stay invested through difficult markets. In closing, today we learned every basket has a different purpose. The safety fund protects you from today's unexpected challenges, and we want low volatility. The freedom fund is designed to build tomorrow's opportunities, long-term horizons. We learned that volatility isn't something to fear, it's a normal part of long-term investing. We learned that market drops have happened throughout history, and while the future can never be guaranteed, history has shown that patient and diversified investors have been rewarded over the long term. We've learned why we've used VFV as our example throughout this course, and why broad diversification and consistency can be more powerful than trying to predict tomorrow's future winning stock. The goal isn't to get rich quickly. The goal is to build a simple system. Stick with it and allow time to work in your favor. Key takeaways: the Freedom Fund isn't about predicting the future. It's built on patience, consistency, and diversification, and giving time the opportunity to do what is historically done the best, which is to grow. Thank you for watching. If you found this lesson helpful, please like the video, subscribe to the channel, and share it with someone you care about. The more people who learn these principles, the more lives can be positively impacted. If you're following along with the course, I'll see you in lesson 10, where we'll explore the Dream Fund. So one last thought and visualization I'd like to leave you with. So think about this. How do you feel future you would be if you owned VFV? And I'll just describe the top 10 holdings that it holds right now. NVIDIA, Apple, Microsoft, Amazon, Alphabet, Broadcom, Alphabet, which is Google. It's in there again because they did a stock split thing. Micron Technologies, Meta, aka Facebook, and Tesla. Do you think that this would be something that would help benefit your future self? Is it going to be a choice you're going to use on the path for the better you of your behavioral compass when you're being the turtle? And for those curious, the sector weightings for all the stocks that it holds, it's heavily biased towards technology at 38%, financial services 11%, communication 9%, consumer cyclical stocks 9%, 9% healthcare, 9% industrials, consumer defensive 4%, energy 3%, utilities 2%, real estate 1.8%, and basic materials 1.66%.